October 19th, 1987. History remembers it as Black Monday. On that day, global markets fell faster and further than anyone thought possible. There were no bombs, no declarations of war, no seismic natural disaster. The catalyst wasn't even a tangible event. It was just data and pure, unadulterated panic. Imagine this. It starts like any other Monday morning on Wall Street. Traders are stepping onto the floor, coffee in one hand, ready for another day of the bull market that defined the 80s. Their screens are glowing a reassuring green, but by the time the closing bell rings, the world has changed. The Dow Jones Industrial Average has collapsed by an astonishing 22.6% in a single day. $500 billion in market value, gone. Just vanished into thin air. To this day, it remains the worst one-day percentage drop in stock market history. So the billion-dollar question is, how? How could this happen? If you're thinking it was just old-fashioned human greed or a massive scandal, you'd be missing the real story. The culprit was something new, something revolutionary, something that was supposed to make markets safer. The culprit was code. To understand Black Monday, we have to rewind a bit. The 1980s were a decade of incredible optimism and excess. Wall Street was booming, shoulder pads were big, and for the first time, computers weren't just giant calculators in a back room. They were becoming powerful tools on the trading floor. And with these new tools came new, complex financial strategies. The most popular one was called portfolio insurance. The concept sounded brilliant, almost foolproof. It was an automated strategy designed to protect large investment portfolios from market downturns. The logic was simple. If the market started to fall by a certain percentage, the computer program would automatically trigger sell orders for stock index futures. This would, in theory, hedge the portfolio, acting like an insurance policy against further losses. It was a digital safety net for a world still dominated by paper and phone calls. Major institutions, pension funds, and universities all bought into it. What could possibly go wrong? Well, on that fateful Monday, the machines turned on their makers. The dominoes started to fall in markets overseas, but the real storm hit when New York opened. As prices began to tick downwards, the portfolio insurance programs did exactly what they were designed to do. They started selling. But here's the fatal flaw nobody fully appreciated. All these different programs, all managed by different firms, were running on very similar logic. They all started selling at the same time. This sudden, massive wave of automated selling pushed prices down even further. And what happens when prices fall more? The programs trigger even more selling. It became a catastrophic feedback loop, a digital avalanche that was feeding on itself, growing larger and faster every minute. The very system designed to protect against a crash was now accelerating it beyond anyone's control. On the floor of the New York Stock Exchange, it was chaos. The noise was deafening. Phones rang incessantly, with desperate investors on the other end trying to sell, but there were no buyers. Traders were shouting, screaming for bids that simply didn't exist. The market had seized up. The paper tickets that recorded trades started piling up on the floor, literally knee-deep in some areas. The iconic ticker tape, which was supposed to provide real-time prices, was running hours behind reality. The numbers flashing across the screens were ghosts of transactions that had happened long ago. No one knew the true price of anything. The digital safety net had become a tangled mess, dragging the entire market down with it. And this wasn't just a New York problem. Panic is contagious. The digital scream of the American markets echoed across the globe. As one market closed, another opened, and the selling pressure cascaded from New York to Tokyo, then to London, then Frankfurt, and back again. It was the world's first truly global, high-tech financial crisis. The interconnectedness that was supposed to create efficiency was now spreading financial contagion at the speed of light. Inside the Federal Reserve Building in Washington, D.C., a new chairman named Alan Greenspan was facing his first major test, just months into his tenure. The situation was dire. The entire financial plumbing of the United States was on the verge of collapse. If brokerage firms and banks started to fail because of the losses, the crisis would spill over from Wall Street to Main Street, potentially triggering a new Great Depression. Greenspan and the Fed acted decisively. They made a simple, powerful public statement before the market opened on Tuesday. The Fed affirmed its readiness to serve as a source of liquidity to support the economic and financial system. In plain English, they said, "We will print money. We will lend whatever it takes to make sure the system doesn't break." They essentially opened the financial spigots, reassuring banks that they would have the cash they needed to stay afloat. For the first time, Wall Street wasn't just listening to the shouts of traders. It was listening to the heartbeat of a computer and the steady hand of the central bank trying to resuscitate it. And it worked. The panic subsided, and the market slowly, shakily, began to stabilize. In the aftermath, the world began to grapple with a chilling new reality. The future of finance would not just be shaped by humans in suits making gut decisions. It would be increasingly written and executed by lines of code. Black Monday didn't end capitalism, but it rewired it completely. Computers were no longer just tools to assist traders. They were on their way to becoming the market itself. This event triggered a wave of changes. The stock exchange introduced new mechanisms called circuit breakers, automatic trading halts designed to give the market a mandatory timeout during moments of extreme volatility, preventing the kind of feedback loop that caused the '87 crash. It was an admission that markets could move too fast for humans to handle, and sometimes the only solution was to pull the plug. But the larger trend was unstoppable. The crash paradoxically accelerated the very thing that caused it: the computerization of finance. The lesson Wall Street took wasn't to abandon the machines, but to build better, faster, and smarter ones. This gave birth to the age of algorithmic and high-frequency trading. Today, the world of Black Monday seems almost quaint. Trades are now executed in microseconds, millionths of a second. Decisions are made by complex algorithms faster than a human can even think. It's estimated that over 80% of all trades on the global stock market are now executed by these algorithms. They are the descendants of the same portfolio insurance logic that once broke the system, but now they are infinitely more complex and powerful. These algorithms move trillions of dollars around the world every single day. Their collective rhythm is the pulse of modern finance. Black Monday was the day the machines first learned to panic, and ever since then, humanity's greatest engine of wealth creation has been running at machine speed, perpetually balanced on a knife's edge between computational brilliance and automated fear. The lessons from that one chaotic day in 1987 are more relevant now than ever before. Thank you so much for watching. If you found this deep dive into financial history interesting, please hit that like button and subscribe to the channel for more stories about how our modern world was shaped. Let me know in the comments what other major financial events you'd like to see covered. See you in the next one.